Hello and welcome to Portfolio Matters. Weekly markets checklist, week 183. And again, it's been a very busy period trying to keep up with Donald Trump. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
First of all, news. So, 25% tariffs on Mexico and Canada have come into effect. 10% tariffs on China have been announced, and a further 10% has also been announced, but we are unsure as to whether those have actually come into effect as yet. Canada has retaliated. All this leads to a trade war, which is bad for inflation, bad for economic growth, bad for income equality, potentially good for the fiscal balance, unless the economy is driven into recession and welfare payments go up and taxes go down, in which case it's bad for the fiscal balance. 25% tariffs on US steel and aluminium imports have also come into effect. The EU announced retaliatory tariffs. The first thing it did was to unsuspend previous tariffs on bourbon boats and motorbikes, and they will now resume on the 1st of April. And it has also announced proposed tariffs on agricultural products to take effect from mid-April. Trump has threatened to retaliate further by imposing up to 200% tariffs on EU alcoholic products. Not good. Elsewhere, OPEC has confirmed that it will begin to raise output in April, and that is bad for oil prices. The ECB cut rates by 25 basis points, but Christine Lagarde warned that monetary policy was now much less restrictive and that there was exceptionally high uncertainty about the economy and inflation, and the path of interest rates was much less certain from here. Germany, in a huge move, announced that it would circumvent its debt brake to boost defense spending and also create an infrastructure fund of up to 500 billion to be spent over the next 10 years. European bond yields rose. The EU also announced 150 billion defense funding loan scheme. All of that adds to fiscal spending in Europe, which is good for the economy, bad for inflation. Equity markets fell sharply after Donald Trump appeared unfazed by the threat of recession. US Treasury Secretary Scott Bessent said that the US had become addicted to government spending and that there was going to be a detox period. Detox period presumably involves pain for the US economy. The US markets did not like that. And finally, Doge appears to be being reined in. Now, we've talked about Doge before and its attempts to cut the government spending. Well, the moment there's been a bit of pain, they've reined Elon Musk in. So elsewhere, the economic data, which we're going to take you through, US non-farm payrolls came in slightly soft, but overall it was a pretty solid jobs report. But we've not seen really much effect of the government, US government payroll cuts yet. They're expected to come through in April. US February CPI inflation came in soft, which is good. Elsewhere, Donald Trump has agreed proposals for a temporary ceasefire with the Ukrainians. The Russians have not agreed to that. And he's previously talked about imposing various sanctions, etc., on Russia if they don't agree to a ceasefire. What happens next? Question mark. Some charts relating to the news. Well, these are what happened to markets after Donald Trump announced tariffs. He was going to go through the tariffs. It was not good. Markets don't like trade wars. And since Donald Trump was elected, actually, all the trades that were expected to do well under his presidency have retraced, and many are now down. But equity markets and falling equity markets are bad for the US economy because households have record high allocations to equities. We'll take you through the equity data later. Now, European defense stocks absolutely went through the roof after the announcement that Germany had removed its debt brake to allow more defense spending. And the flip side of that was that bond yields rose everywhere in Europe and in the UK as markets discounted more debt issuance and potentially higher inflation. If he imposes reciprocal tariffs, as he's threatened to do, and 40% on China, he could get to tariffs of almost 20 odd percent. Currently, we're looking at average tariffs of around 11%. In 1890, when President McKinley raised tariffs, that led to higher inflation and was immediately unpopular, causing the Republicans to lose votes almost immediately in the midterm elections. Let's see what happens this time. And tariffs and economic policy uncertainty is causing more fears about recessions. This morning, the FT had an article saying that US retail footfall was down 4.3% year on year in March, and there is growing evidence that US consumers are becoming more cautious. On to this week's economic data, Richard.
Thank you, Keith. So the summary, it's not really good news for the world economy. The UK, EU, US and China are all in stagflation other than China, which is in stagnation. So things are slowing down. Yeah. UK GDP month on month is down 0.1%. And yes. That's bad news for Rachel Reeves.
Yeah, and worse than expected.
And year on year, UK GDP is 1% in January and expected 1.2%. Still looking extraordinarily lackluster.
Yeah, so we've had 2 years now of basically flatlining growth.
And production sector was mainly responsible for the fall in GDP. And that shows that UK manufacturing is not doing well. Here we have UK industrial production down 0.9% in January, much worse than expectations. Which
is particularly disappointing because you might have expected a surge in production as manufacturers tried to get ahead of US tariffs. But for the UK, that certainly didn't happen.
No. And industrial production year on year, down 1.5% in January. And that's, again, significantly worse than expectations. So the poor old UK industrial sector. UK construction output year on year is down 1.5% in January, worse than expected. And the British Retail Consortium monitor was 0.9% in January, which is significantly worse than expected. And UK Bank of England consumer credit was up at and 1.7 billion in January, and significantly, I would say worse than expected in the sense that consumer credit is rising.
Yeah. Well, it's ambiguous, isn't it? Are people borrowing more because they're confident or borrowing more because they're desperate?
Precisely. I suspect it's the latter, Keith. Who knows?
Yeah.
I suspect the latter. UK mortgage approvals basically flat at the moment and pretty much in line with expectations.
But actually amazingly strong given higher interest rates.
Yeah. And UK net mortgage lending was 4.2 billion in January, which is better than expectations. And that chart is showing that net mortgage lending increasing every month, effectively on an upward trend.
Yeah, but apparently everyone was rushing to complete before the rise in stamp duty, and you'll see that there's been a fall of confidence since January.
UK net lending to individuals was nearly 6 billion in January, ahead of expectations. And again, is that because people are short of money or because they want to spend money. M4 money supply starting to move upwards, up 1.3% in January, and at the top of that range that it's been in since 2000 and mid 2002.
Yeah.
Continuing the relentless upward trend.
Yeah.
I would suspect UK construction PMI was 44.6 in February, significantly below expectations, worse than January, and looking pretty sickly there the last few months.
Yes, it has. It looks really sickly, actually. And I was surprised by this because I thought, government had promised to increase public sector spending on infrastructure.
But the planning process hasn't been freed up yet, has it? I guess there's a
Mm.
big lag, so we shall see. And this is construction companies indicating a reduction in staffing numbers for 2 months consecutively. And you could see that the activity is declining in all sectors: housing, commercial, civil engineering.
Yeah. I was surprised by the civil engineering part.
Yeah, I mean, that's a lot of that is infrastructure projects, isn't it? I guess construction companies reporting rapidly rising costs of labour and raw materials, and that is an unpleasant looking chart, I would say.
It is. It is very unpleasant.
UK new car sales year on year was down in January, but not as much down as expected. So it's in fact very significantly better than expected. UK house price balance was 11% in February, significantly down on expected. Now, interestingly, so my daughter is selling her flat, and she reduced the asking price to just below 300,000 because 300,000 is the stamp duty threshold now, and the sale won't go through until after the thresholds change.
Ouch.
So I suspect that we might be seeing this occurring not throughout clearly, but at the bottom end, the bottom end of the housing market.
Yeah.
So house prices index month on month, down 0.1% in January, but up 2.9% year on year. And the economic surprise index oscillating wildly as usual.
Yes, but this week, the last 2 weeks, we're generally missing in the UK. None of that data is good.
Agreed. UK Indeed job postings index continuing down. I mean, I just would like to get underneath this indicator to understand whether it's people using Indeed less or job postings are actually declining. What the relationship.
That's true. But I think we're seeing from the ONS as also this general decline in job postings, which makes total sense, given the rise in NI, etc.
Yeah, I would agree, Keith. And the recipients of disability benefits are staying on their benefit for longer, and of course, the Tories completely messed up personal independence payments, but completely, utterly, totally shambolic.
Yeah.
As is their way, he said, as a conservative vote.
Exactly.
UK rental inflation is down to 3%.
Yes, so this is a really good chart, actually. This shows what you should expect, the disinflationary process after the extraordinary, monetary easing and fiscal stimulus of the COVID. You expect inflation to come right back down to where it was previously, and we're getting there.
Exactly. UK food inflation basically looks pretty much like it's plateaued, doesn't it, for a few months, and now various elements of it are starting to go back up.
They are.
And one might actually add, in terms of personal experience of grocery shopping, you might add in and the rest.
Yes.
Because my personal experience of grocery shopping is not 4% annual inflation.
No, I agree. Actually, we covered this last week, but this corroborates the
permanent placements. I find this one hard, Keith. I find it hard to interpret.
Yeah, so basically the number of jobs placements is continuing to fall, and it's continuing to fall. But it's now been falling, for 2 years? Over 2 years?
Yeah.
So more evidence the labour market in the UK is weak.
Yeah.
Now, the good thing is, and they didn't provide a number, but they said that February had the lowest wage growth in 4 years.
So UK trueflation has stopped rising, it's flat for a month or so.
Yeah, and it's
2.6%.
not rising again. The trend is,
Yeah.
if there is a trend, but it's stable at above the Bank of England
Yeah.
target. Now, we don't report this every week because when you look back at the history, you
Yeah.
get some very silly numbers. But you have to trust that I don't know, their contemporaneous data is in some way better than their historic data.
So there's a summary. Have a read, but bottom line looks like stagflation.
Yeah. And we have a big date coming up in the OBR reports on the 26th of March.
Yeah.
Whether the government plans are compatible with its fiscal targets. And we know that bond yields have risen and the economy has slowed, and that the OBR's productivity assumptions may be overly optimistic. All of that means that it's likely to be a bad report that says that the government will need to cut taxes. Sorry, that says the government will need to cut spending and raise taxes to balance the books. Now, reports in recent days suggest that their plans for spending cuts, and particularly the welfare bill, have been received a lot of pushback from Labour MPs, which means that they're going to have to raise taxes.
Yeah. And that is bad in turn. Will be very bad in my view for the economy.
Yeah. Well,
And
the thing is, they've completely messed it up, Richard. So now their own fiscal rules are forcing them to have pro-cyclical fiscal policy.
yeah, I mean they are really struggling under the legacy of the Tories. There's no doubt about that. And this fiasco with the personal independence payments.
Yeah.
It should never have happened. And of course, Labour MPs. The problem is it should never have happened in the first place. And now it has happened. Labour MPs are objecting that it shouldn't be undone, but actually
Yeah.
it has to be undone for the health of the economy. And that sort of. And I don't really understand their thinking because I don't think it'll affect their electoral chances at one iota.
The thing is, when you give people entitlements, they become used to them. It's very difficult to take them away. And what the Tories did was just throw money at everything.
Yeah, but apparently there's 1,000 new successful PIP applicants a week.
Yeah.
I mean, it's absurd. It's
Yeah.
it has to stop. It has to be undone. I just think that the Tories, the degree of incompetence that comes out of the Tory government, is never-endingly worse.
Yeah. Well, they're in power for too long, sadly.
Yeah.
And onto the EU. So the ECB met and they cut by 25 basis points as expected to 2.65%. But Christine Lagarde warned that monetary policy was become meaningfully less restrictive and the path of future interest rates was now more uncertain. We had revisions to Q4 GDP growth and they were good. So the EU economy grew by 0.2% in Q4, up from previous estimates of 0.1, and 1.2% year on year, up from the previous estimate of 0.9. So EU economy actually resilient. We also had inflation numbers. Now, headline 0.5% in February was in line with expectations, but not a good number. But it was lower than last year, which is some small benefit. And although it missed expectations, it still fell month on month. So that is good news. Core also came in above expectations, but down on January. So EU inflation is falling once again. And the ECB is confident that inflation will fall further later in the year. And the good news in EU inflation is that service inflation is coming down. So here you're looking at the blue line, and having been flatlining at far too high a level for much of the past year, it has started to fall again, although obviously 1 month does not make a trend. The EU unemployment rate was stable at its lows at 6.2%. So although the EU economy is stagnant, it's not suffering from job losses. Industrial production in January, unlike in the UK, was up 0.8%. Is that evidence of pulling forward orders to get ahead of the tariffs in the US? Year on year, industrial production was flat. Retail sales in January, disappointing, down 0.3%, missing expectations. Year on year, 1.5%. Construction PMI, having looked like it was perking up, has collapsed once again, and that is an absolutely terrible number. The Economic Surprise Index, though, will confirm Richard's skepticism in that it's surprisingly positive, even though the economy is a bit rubbish.
What is noticeable about both those charts, Keith, is that there is a downward sloping line at the right-hand end joining the peaks. In other words, the positive economic surprise are getting less.
Oh, right. Yes, you're right.
And it's true of the UK one as well.
Oh, very good, Richard. Oh dear. German Indeed job postings. That's not good. It's last few weeks we've seen further sharp falls. France just steady declines. Now, Goldman Sachs has massively increased their German GDP forecasts following the government's announcement it would borrow potentially unlimited amounts for defense spending. And they expect the government to go for growth. And that's a big change.
The problem is, so it's just the only problem is, and I'm not disputing that Europe needs to spend a great deal more money on defence, but the problem is they will simply dig themselves into the same debt trap that everybody else is in.
Germany has suffered very low flows into its equity markets in recent years compared to the US in particular. If that reverses, German equities could have a long way to go. But on Richard's point, Italy has a debt to GDP of around 135% and rising bond yields. So Germany, increasing its fiscal spending, has increased bond yields throughout Europe. And also Germany loosening the fiscal taps will embolden other governments throughout Europe to, not rein in their spending. And when you look at Italy here, 135% of GDP, record deficit in the first 2 months of the year. We have been forecasting a crisis in the Eurozone for many years, but at some stage, these are unsustainable. And gone.
And I think the point for me has always been that Germany's there as a backstop. If Germany starts to load up with significant additional quantities of debt, it no longer is a backstop.
So Germany used to have some moral authority as the fiscally prudent country in Europe. If it's now losing that, then what is going to constrain the countries on the periphery? So in summary, Europe is stagnation for now, but if Germany increases fiscal spending, that'll provide a boost for the Eurozone economy. Now, I don't think that the Eurozone really has an inflation problem. And actually, this could be good for the Eurozone economy.
It could be good for the Eurozone economy if, but my concern is that they're simply increasing the debt, Keith. And what we know is that countries increase debt and they never succeed in reducing it. And unless unless governments are made smaller, they will simply continue to fall into the debt trap.
Well, my concern about the Eurozone in particular is that the feedback mechanisms don't work to constrain the debt levels. So you've seen in the UK, the bond market has had conniptions about the level of UK spending. And so the UK government now has to rein in the fiscal deficit.
Yeah.
In the case of the Eurozone, that doesn't work because the ECB has been interfering in the market to lower Italian bond yields. And so The Italians in particular, are borrowing just far too much money, and at
Yeah.
some stage, I think there has to come to a crisis of some kind. Now, in the last case, Greece chose not to leave the Eurozone and undergo 15 years of quite amazing austerity to stay within the Eurozone. I think something similar is inevitable in Italy. It's a question of when.
I agree, Keith. I think it's really unclear as to how it's all going to resolve as well.
And on that cheery note, on to the
Yeah.
US.
So US non-farm payrolls, February 151,000, which is actually very close to expectations. Nothing to see here.
Yep.
And January non-farm payrolls were revised down by an actually relatively small number, only 18,000. And the jobs report showed some effect of the Doge job losses. But as Keith said earlier, we expect more of that to come through in April, and there's continuing strength in the construction sector.
I know, amazing. I've had, there's no evidence really in the jobs numbers. The US economy is doing poorly at all. It's doing fine.
Yeah. Most of the new jobs went to native-born workers. So is that a consequence of Trump's immigration policies? We shall wait and see. Just on immigration, apparently 7.5 million Venezuelans have immigrated in the last few years, which is a quarter of the population. Now, not all to the US, some of them have stayed more locally in South America.
Yeah.
A quarter of the population has left the country.
Yeah, that's the joys of socialism, mate.
Yeah, it's extraordinary, isn't it? We've got this huge difference between the establishment and household surveys. And the establishment survey was 151,000, the household was minus 588,000. So which do you believe? Something's clearly awry somewhere. And if you adjust the household survey to reflect non-farm payroll methodology, you still get a loss of 179,000 jobs in February. So this is US average weekly hours, which is just on a slow downward grind.
Yeah. No, because this portrays a weak US economy.
Yeah. And average hourly earnings month on month grew 0.3%, which was in line with expectations. And US average hourly earnings fairly flat at the moment, actually 4%, consensus 4.1%. US unemployment rate 4.1% against expectation 4%. And the U6 unemployment rate was 8%, and up against expectations, and also continuing its rise since early summer 24.
Yeah, I thought this was an interesting number, So that means there are the difference between U6 and the unemployment rate implies there are a lot of discouraged workers who are no longer claiming benefits or whatever. Don't know. But that's quite a big number, 8%.
Yeah, it is. And rising. And if you ignore seasonal adjustments, the unemployment rate rose to 4.5%.
Yes, but of course, seasonal adjustments are valid.
Yeah. And the unemployment rate has steadied because we probably have competing upwards and downward pressure. Although I think we're going to get more competing downward pressure over the next few months.
I think you're right.
This is the ADP employment change, which was 77,000 February, but very much below expectations. Challenger job cuts, big jump there, 170,000 in February against an expectation of 56,000.
Yeah, so these are announced job cuts. They will come through in the coming months.
And 41,000%.
Yes.
Spike in February layoff announcements, in part because of 62,000 federal workers who are expected to become redundant by April.
Yeah. Now you notice that also, although this spike, this big headline number here, was 62,000 federal workers, actually the total number of announced job cuts was 172,000. And speaking to my American fund manager friend last week, he was saying that the spike is not due to federal workers is due to government contractors. They get laid off much faster. So when you cut the contracts,
yeah, it's quicker, isn't it? It's easier to do. The JOLTS job openings, 7.7 million in January, pretty much in line with expectations.
Yeah, and actually that looks fine.
And the JOLTS quits, 3.2 million in January, again in line with expectations, continuing to decline gently.
Yeah, but this suggests that the jobs market is actually strengthening. We question that.
Yeah. And the JOLTS layoff rate dipped in January, but suggests a suggestion of a rebound in February. But I mean, it's quite a noisy little chart, that, isn't it? So I think we need a few more months' data.
Yep.
Hiring rate is remaining low, and the bonanza of people moving jobs for a pay rise has finished.
Yeah, you see, this I think is actually a really interesting and important chart. So what it's saying is companies are no longer paying up to try and attract workers. They don't want new workers.
Yeah. And wage growth for low-skilled workers is falling significantly faster than that for high-skilled. AI, anyone? CPI month on month, 0.2% in February.
Below expectations.
Yeah, and year on year, 2.8% in February, pretty much at expectation. Core CPI, 0.2% in February, below expectations, and year on year, 3.1%, which is basically the same as expected. And this chart's just showing that inflation is continuing to slowly fall down towards the Fed's upper target range, 2.5%. And the CPI ex shelter is currently at the 2%.
Yeah, absolutely. So, shelter inflation is keeping CPI higher than it should be.
Yeah.
Actually, there's not much inflation in the US.
Rental inflation looks like it has further to fall to come down, so it coincides with its long-run trend of being a little bit below the average rent index. And much in the drop in super core services was due to airfares.
Yeah. So actually, although inflation in February came in below expectations, much of the miss was due to airfares, which is very volatile.
Core goods also rose before any effects of tariff.
Yeah, and that's not good.
And bond markets are expecting tariffs to cause an inflation rise.
Yes.
Surprisingly. So the biggest inflationary input by far is auto insurance.
Yeah, and we've talked about this before. This is not something that is amenable to being reined in by higher monetary policy. It's just, EVs are much more expensive to fix, basically.
And obviously, the big question is, are tariffs going to start affecting US businesses? And there's a steep rise in small businesses reporting increases in costs that has just occurred.
Yeah, that's right. And this leads by 3 months, apparently, says.
Yeah.
So not good.
So the US PPI month on month, February was 0, below expectations, and year on year it was 3.2%, which is pretty much in line with expectation. And core PPI month on month was down 0.1%, which was better than expected. And year on year, it was pretty much at expectations at 3.4%.
Yeah, and PPI, we think, leads CPI by about a month. So that bodes well for February, for March CPI.
Yeah. National Federation of Independent Businesses optimism, having spiked up with the Trump election, looks like it's in the process of reversing that spike. Labour productivity up 1.5% in Q4, better than expected.
Yeah, the UK would kill for these numbers.
Yeah. And unit labour costs quarter on quarter, annualised 2%, 2.2%, which is lower than expected, which is good. And Fed consumer inflation expectations 3.1%, in line with expectations, basically, and fairly flat over the last 12 months.
Yeah. Now, I would expected more it to go higher because of tariffs.
Yeah. The ISM manufacturing PMI is at 50, in line with expectation. ISM manufacturing new orders fell quite sharply in February.
Yeah, that's not good.
And ISM services 53.5, slightly ahead of expectations.
Well, you see, I thought this was a really interesting number because, everywhere we're hearing doom and gloom about the US economy. But actually, services, biggest part of the economy, just fine.
Yeah. Services new orders 52.2, slightly ahead of expectations.
But weak.
Yeah. Global services PMI 51, dropping, but ahead of expectations.
Well, because this is the second, this is the revision. So initially they said 49.7. We reported that last time, but actually they've revised it up. So it's not good, but it's substantially better than their first estimate.
Yeah. Factory orders month on month at 1.7, having been revised up from December. Construction spending down 0.2%, which is worse than expected.
Mm.
And Michigan's consumer sentiment index at 58, which is below expectations and is dropping quite fast.
Yeah. Now, most of the data we report, there's a lag. So we're talking about official data. This is survey data. And a lot of the data we're seeing about US consumers, such as the FT reporting, there's been a 4.7% fall in footfall in retail sales year on year. Most of the latest data suggests that the US consumer is feeling insecure and underconfident.
Yeah. And it's Michigan current conditions, which is at 63.5, which is a bit below expectations. Michigan consumer expectations sort of looks like it's falling off a cliff, really. 54 versus 64.3 expected. Down a lot. And 1 year inflation expectations of nearly 5%. And that's a sharp increase.
Yeah.
5-year inflation expectations, a similarly sharp increase, nearly 4% and ahead of expectations. And the consumers see the labour market falling off a cliff, actually.
Yeah. Now, look at when that's happened before.
Yeah.
That is generally, that is contemporaneous with a recession.
Yeah, it's a very recession indicator, isn't it?
Hmm.
The economic optimism index dropping back from its recent high.
Yeah, but then it was below 50 for this whole period. The US economy was doing quite well.
Yeah. Total vehicle sales, 16 million, looking sort of pretty much in line with what you'd expect.
Absolutely, that looks fine.
And balance of trade, minus 131 billion, which is slightly below expectations.
Yeah, everyone rushing to get ahead of the tariffs, basically.
Initial jobless claims, 220,000.
Yeah, fine.
Yeah. Continuing jobless claims, the same, fine.
Yeah, essentially, there's been no change in the last 6 months.
Yeah. Initial claims in US federal employees higher than usual, but still tiny. And Indeed jobs postings index very slightly down.
Yeah.
And LinkUp continues to report rapidly declining job openings in the US. I would say LinkUp is at odds with all the rest of the data.
Yeah. Well, the thing is that the Indeed data does show it declining, but not to this extent.
So weekly economic GDP from Dallas 2.7%. Fed Atlanta Fed 2.4%, minus 2.4%. I mean, it'd be a lot of art. This is some sort of artifact due to tariffs or whatever. We don't know, but it's not real.
Well, we think it's due to gold imports.
Yeah.
But Richard, when you look at the components of the Atlanta Fed GDP now, even if you exclude the gold imports, so net exports is the red bars, yeah. you would see rapid decline in their numbers.
The New York Fed GDP nowcast 2.7%.
Yeah, so most of the nowcast not showing any deterioration in the US economy.
St. Louis the same. And the Citigroup Price Index a little bit negative at 9.7. Soft data macro surprises have been quite pessimistic, quite negative for consumers.
Yeah, that's so, consumers are feeling increasingly negative about the economy, and that's yet to come through in the hard data.
And US trueflation, 1.7%, a bit of a spike, but still well below 2%.
So I was reading on the Trueflation Twitter feed that they claim to have a very good correlation with CPI, but lagged by 45 days. So they are saying that this fall in US inflation will be reflected in April.
Right.
So let's see.
Yeah, interesting. Paychecks is reporting a bounce in hiring by small businesses in February, although on the big chart, it's almost invisible.
Yeah.
In terms of the fiscal of borrowing, the US has had its first worst ever start to a fiscal year, and Doge, Elon Musk, has a great deal of work to do to try and bring all of this under control.
He has. Now, actually, on the I was listening to The Rest is Politics, and they were talking about the UK and surveys of the UK voters, and they were saying that they agreed that the government needed the government had the resources, yeah, to provide the public services that we required, but that the UK citizens had no confidence in the politicians. So what they didn't want was higher taxes. What they wanted was the existing money being spent
Properly spent,
effectively.
yeah.
And so, Doge, you can see they really do need to get the fiscal deficit under control. And Doge, there is a role for cutting back the size of government. But in the UK, voters wanted it done sensibly rather than just taking a chainsaw to everything in sight.
So, yeah, I mean, I was struck up. There was last week there was an article about the effect, well, basically the shutting down of NHSE, which employs 16,000 people, vast bureaucracy, and the chairman who recently resigned said it was unfortunate because they just spent a great deal of money on consultants to reorganize themselves. And for me, that is the problem.
Yeah.
That people think that that it's appropriate to spend millions of pounds on consultants so you can reorganize. It's like they simply don't get it, these people.
Yeah. Yeah.
So this is back to the US. Much of the excess spending in October and November was under the Biden administration trying to get as much money out of the door as they could before Trump came in.
Yeah.
Somewhat dishonorably, one would think. And interest expense on US public debt outstanding is, of course, rising steeply.
Yeah.
And continuing to rise steeply.
Yeah, 1.2 trillion. I mean, that's just an absolutely shocking number.
This is EU tariffs on bourbon, which are going to hurt.
Yeah, I thought this was amazing. So this is a number of bourbon distilleries in the US.
So what we're saying here is that the EU tariffs on bourbon are highly effective in reducing, in damaging the US bourbon industry. Is that right?
I think so, yeah.
Here we have the US national debt clock, $107,000 per citizen. That includes children, by the way.
Yeah.
$323,000 per time. It's like per taxpayer.
Yeah.
Oh, the dodgy clock. Is that what they think they've saved? They can't have saved two.
Yeah, I know. So we don't believe this. We don't believe this, basically.
Not yet. I mean, a nice target to have, and they obviously need, if they want to make a difference, it's got to be a lot bigger than that. But
yeah,
there we are. They claim only 115 billion in savings, and much of that is undocumented. We shall see.
We shall see. I think So the rest is politics US, which I listened to with Anthony Scaramucci. He was saying that he thinks Doge is now dead.
Dead as a dojo.
Yeah.
Dodo. Yeah. There we have the summary. And bottom line, consumer sentiment is falling. There's policy chaos and little sign of economic slowdown as a consequence of it. I would just comment that a lot of people are saying this is chaos, this is chaos. Trump has a goal in mind, and it may be that the only way to achieve this goal in any sensible time frame is to introduce a degree of chaos. And I'm not convinced the whole thing is entirely chaotic. It is messy, but not necessarily chaotic.
Well, I think his aims, in part, are admirable in that, to cutting the size of government and reducing waste. Um, unlike in the UK, I mean, he is actually attempting to tackle the size of government, but he's not doing it in a sensible manner. And also his policy, foreign policy, and tariffs, they're on, they're off. I mean, in putting together this podcast, I mean, we tried to work out whether the tariffs, 10% extra tariffs on China had come into effect yet, and we weren't sure.
Yeah.
It's chaos.
I think the danger is that people, you read it actually, for example, a lot in the Financial Times, they only ever say anything that's critical of Trump. They never say anything and as you say, Keith, what he's trying to achieve is admirable. And I'm not, he is trying to achieve something quickly that is very difficult. And I think rather than disparaging him continuously, we sort of rather need to wait to see what the outcome of it is. And there's a trap that one could fall into, which is just constantly joining in the queue of criticisms without seeing whether they are ultimately going to achieve their objectives. I don't know whether they will, but I just think that as a responsible society, we need to take a step back and look at what he's trying to do.
And occasionally a shock is needed to the system.
Yeah.
But I think you would administer a shock in a controlled manner rather than an uncontrolled manner. Anyway, we'll see what happens.
We will indeed, yeah.
And on to China, and actually quite a lot of data in the last couple of weeks. So first of all, CPI. Well, China fell back into deflation in February and year on year back into deflation. And these are quite big numbers, 0.7% down year on year. So that is evidence, frankly, that the Chinese economy is not doing well. And if exports fall because of tariffs on the US imposing tariffs and cutting Chinese exports, then Chinese manufacturers are going to have a lot of goods they're going to try and be placing into the domestic market. And that could further exacerbate deflation. So producer price inflation, negative year on year, 2.2%. Balance of trade went through the roof as importers everywhere tried to get ahead of tariffs. Exports were 2.3% year on year. That's good. And actually, the cause of the big rise in the trade surplus was not exports, which actually were disappointing. It was imports, which collapsed. Interesting. The National Bureau of Statistics general PMI was at 51.1. Believe what you will. Caixin at 51.5. China's economy doing okay, but new loans disappointing in February, down on expectations. Social financing down on expectations. Outstanding loan growth continuing to decline. Foreign direct investment still terrible, minus 20% year on year. Been falling for a couple of years now at an accelerating rate. And China continues to attempt to export its way out of trouble via an undervalued yuan. So in summary, China, the PMIs show a Chinese economy that is barely growing, deflation returned, and that is not an indication of a strong economy. Loan growth was weak, FDI continues to contract. Stagnation. and onto one chart. Now, this is European defense spending over time. So the dark blue line is the US. The UK is the pink line. Now, in the 60s, we were spending an average of, let's say, 7% of GDP on defense spending, and that has now fallen to just over 2%. France in the 60s was spending 4%, Germany 3.5%, and they've both now fallen to below 2%. So we have benefited from a big peace dividend. And if we're now going to be unwinding that and increasing spending on defense, then that means we're going to have to either raise taxes or cut welfare payments. And cutting welfare payments is difficult. So although Richard bemoans the incredibly high level of UK taxes, frankly, I just can't see the UK government having the courage to cut welfare payments. And so I think the only way is up for taxes.
I don't know, Keith. I mean, they need to, but whether what I can't get my head around is why Labour MPs would object to personal independence payments being curtailed. I mean, it's like money grows on trees. It doesn't. And I just find that extraordinary and very, very disappointing.
The thing is, if you listen to Radio 4, you'll think the money does grow on trees. But, what matters is people's feelings. They feel they're entitled to this money. And the Labour MPs, Jeremy Corbyn is calling for a wealth tax. What they want to do is increase welfare payments and, tax the rich. That's you, mate. They've seen your gold holdings.
They want to totally destroy the UK economy.
Yeah. And after that, cheery piece. So, what does the Kalecki-Levy model say about what Donald Trump is up to? Now, reminder, the Kalecki-Levy model defines corporate profits as investment plus dividends minus household savings minus government savings minus rest of world savings. And you can read the definitions down there. Now, we have covered this before. And the Kalecki-Levy model has been predicting that US corporate profits would be really good because of the big fiscal deficits in the US, which, we were previously forecasting that US corporate profits would fall after the pandemic because the fiscal deficit would be reined in. And then Biden completely turned around and increased the fiscal deficit again, despite the US economy doing okay. So Biden had a pro-cyclical fiscal policy, raising the deficit when the economy was growing. Now, let's look at the components of the Kalecki-Levy model and see how they'll affect corporate profits. Well, investment. I think that's likely to fall as a result of Trump economic policies because in order to make any sort of long-term investment, you need certainty. And also the cost of capital is higher because interest rates have been rising. So that will tend to have a negative effect on corporate profits. Dividends is a lagging indicator, have little impact, I would say. Household savings. Well, we know household savings are currently very low, and increased uncertainty, increased job insecurity will tend to raise household savings, and that would be down for corporate profits. Government savings, well, Trump is attempting to cut the deficit, which means savings go up, or actually the deficit goes down, the amount of dissaving falls. And that will also have a negative effect on corporate profits. But tariffs will tend to reduce the trade deficit, and that would be good for corporate profits as consumer and business spending is diverted from buying overseas goods to buying domestic goods. So the outlook for corporate profits depends on what you think the balance of those numbers is going to be. Now, I think that is probably likely to be negative. Richard, your thoughts?
Yeah, I think it's likely to be negative too, Keith. I think undoubtedly, yeah. I mean, government savings, yeah, it's all going to be negative, isn't it? I can't disagree with anything you've said.
So, watch this space. If Trump gets his way, corporate profits, according to the Kalecki-Levy model, should fall. And that is bad for a US equity market which remains extremely highly valued. Now, on to Germany.
So looking at German spending plans, which we covered briefly earlier on. So the new Chancellor in waiting, Friedrich Merz, intends to increase defence and infrastructure spending. And any defence spending above 1% will be excluded from the debt brake, which basically means they've got a blank check in terms of that. And the EU is proposing to exempt defence spending from all nations from its fiscal rules. And we have Germany having a 500 billion euro infrastructure fund to be created, to be spent over the coming decade to sort out their railways and roads, etc. But there is the need for a two-thirds supermajority to pass, and the necessary votes have been achieved after the backing of the Greens. I would just say Italy, I think, has quite a strong defence manufacturing industry, doesn't it?
It does.
So this actually may aid the Italian economy to an extent.
Yeah. All those tanks that go faster backwards. Very popular.
So a lot of money being spent on defence.
Yeah. Well, I don't think we've got any Italian viewers. So
okay. Well, if we have, we haven't now.
Yeah, well, exactly.
So Germany's debt levels, which has been falling very roughly over recent years, but obviously it's going to start rising sharply.
Yes. Now, but 500 billion infrastructure over 10 years, that's not that much, honestly.
Yeah. It's 50 billion a year, isn't it? I mean,
yeah,
it's a help.
It's a help, but it's not huge.
No.
So what I'd say is that if the EU excludes defense spending from the fiscal rules, that is a huge thing.
Yeah.
And, they can exclude it from their fiscal rules, which they don't enforce anyway and have no effect. But what it will mean is debt to GDP ratios. Italy, 135%, and not reining in its fiscal deficit.
Yeah.
At some stage, this gets bad.
Yeah. I mean, not including them doesn't mean to say that they don't that severely damage the economy.
Well, there's political constraints on spending, and then there are market constraints on spending. And so you can loosen the political constraints, but at some stage, the market's going to say, actually, we don't trust this unless the EU inflation falls again to, negligible, in which case the ECB can start buying debt again.
Yeah, good point. So this is German bond yields leaping up on the news.
That's a big rise.
Yeah. So the implications have been really discussed. Good for equities, particularly defence and infrastructure. And but the euro, we're going to have higher interest rates, probably stronger growth, and but very bad for fiscal balances.
Yeah. And on to UK electricity prices, which we've talked about a lot. Now, previously talked about how expensive the UK's transition towards net zero is. And Professor Gordon Hughes of Edinburgh University has scrutinized the government's 2030 net zero energy plans, and it's not good. So in order to meet the net zero plan by 2030, the UK will require 150 billion in investment in new solar and wind farms. But we have an aging fleet of gas and diesel generators, and we will need to replace a lot of our combined cycle gas-fired power stations. And he estimates that not only will we need to replace them, we'll need to increase the capacity of our gas-fired power stations, because we have nuclear reactors which are retiring, and we'll need to create a bigger buffer in case there's a lack of electricity from renewables and from abroad. So what's happened in the last few years is that although we've added interconnectors to the continent, there's been resource nationalism. So other countries have made it a policy to stop exporting electricity if their own power supplies come into question. And of course, as renewables become a bigger part of the mix, poor weather for renewables in England tends to be replicated across the continent. So when the UK is suffering from low energy generation, so is much of the continent. So building new gas-fired power stations is estimated to cost 30 billion, and contracts for backup power plants have risen from 120 million in 2017 to 1.1 billion in 2024, and Professor Hughes estimates this will rise to 7.4 billion by 2030 to achieve the government's net zero plans. Now, and so far we've just talked about energy generation, which is only 50% of bills. Network charges will also have to rise as we try and integrate all these variable renewable energy sources into the grid. And so he estimates there'll need to be a 65 billion investment in the grid by 2030. Network charges will rise by between 80% and 120%. Now, this is a really interesting and useful chart. So what this is the shortfall in UK power generation over a year by the number of hours. So on the y-axis you have annual hours of shortfall, and on the x-axis you have the amount of generation that is lacking. So you have 4,500 hours of a little generation being needed, but you also have a non-negligible probability of in excess of 30 gigawatts being needed. So because there is a small but positive probability that poor wind conditions, i.e. lack of wind, lack of solar, would mean that the UK needed 40 gigawatts of backup power, with a 10% margin of error means you're going to need 44 gigawatts of backup gas and diesel generation. Renewables would also generate significant surplus energy, electricity, and according to Professor Hughes, by 2030, renewables would generate an expected annual surplus of around 6,200 gigawatts, which is the area under the curve in the chart on the left. And if the government has to pay £100 per megawatt hour to generators to compensate them to turn off, because it can't use that electricity, then that would also mean they had to pay 620 million to generators. And this is balancing costs as you add solar and wind to the mix, so your balancing costs increase, and it's expected to increase from about 3 billion in 2024 to 7.4 billion in 2030. Of that cost, around 86% is due to wind and solar, up from 66% currently. So, bottom line is in this table. Pause, take a look. According to him, in order for the government to meet its net zero 2030 electricity plan, UK household electricity prices will rise 70% over the next 5 years, or an extra £925 per household. I would say I think he's being rather conservative in saying we're going to need 50 gigawatts of new gas-fired electricity generation. His own numbers would seem to suggest it was 44 gigawatts, but anyway, and that is in the worst case scenario. Richard, your thoughts?
It's appalling, isn't it, Keith? I mean, we want to be a modern industrial economy, and our politicians are playing games with it and not understanding what they're doing. I think it's completely appalling. I'm not an advocate of burning fossil fuels. I'm not an advocate of wasting resources on renewables. I'm an advocate of sensible, pragmatic solutions to the problem, and we just seem to have none of those around at the moment.
Yeah.
And I just think it's a disgrace.
Well, I think there is increasing concern, actually, about the rise in UK electricity bills. And you notice that Ed Miliband's department is likely to face cuts. Now, how those cuts will affect his agenda, I'm not sure.
But it depends whether Ed Miliband is cut, doesn't it?
Well, we can but hope.
Which would be the best thing.
Yeah.
Guy's bonkers.
So,
it's just so sad, isn't it? And it's, again, this is decades, or yes, probably decades of mismanagement of our energy infrastructure. And it's been obvious for, I would say, 20 years that it's needed fixing, and no government has fixed it.
Yeah. Well, watch this space. Let's hope the government changes course, is all we can say.
And of course, finally, we're so exposed, as you point out, with interconnects and so forth, we're so exposed to not being able to generate the energy we require for ourselves. It's a nonsense strategy.
Mm. Actually, we were talking previously about the liquefied air storage, energy storage. And I was thinking, as part of this, that doesn't work. That just adds extra cost to the whole system. Because if you think about it, let's say we have a 4-day period in which the wind stops blowing. So for the first 10 hours, you have this liquefied air system providing energy. So you have to pay them to start generating, and their costs are going to be, the cost of the original energy that they bought, which presumably was free, but also they have to, the cost of the whole machinery, etc., has to be included in their price. But then after 10 hours, you need to turn on the gas turbines. Now, the gas turbines, their cost is going to be the cost of running those in backup, having them in maintenance, etc., for the whole year. And you're still going to need them, but you're going to need them for a shorter period. So their price over that period will inevitably rise. So by adding, your liquefied air gas storage, you've just added more capital and more cost into the system.
Yeah, I completely agree, Keith. It's just bonkers. It's all thought about from some sort of weird, politically correct point of view, which actually, when you think about it, generally doesn't add up. And it's parochial, it's foolish, it's uninformed, and it needs to change.
Yeah. Now, I prepared a piece on Donald Trump's tariffs in the first term, but we don't have time for it again this time. So quickly on to Inflation Watch.
Okay.
Richard.
So here's our revised table. So the US CPI in February was 2.8% down, core CPI 3.1% down, and interest rates at 4.25 to 4.5%. The EU 2.4% CPI in February down, 2.6%, core CPI down. And China inflation was minus 0.7% in February, CPI, and core CPI minus 0.1%. And the Chinese rate of interest 3.1% currently.
Yeah.
So the general trend is downwards.
But now this chart shows that actually, if there's a recession in the US, they could cut rates a long way because rates are still quite restrictive in the US.
And boy, wouldn't they love to, so they can reduce their borrowing costs.
Well, absolutely. We need to fiscal sustainability. You need to get inflation expectations under control.
Yeah.
So actually, Trump trying to cut the size of the deficit is a good thing, but actually, that's only true if he also doesn't spend it by extending the tax cuts, etc.
Yeah. Okay. So a quick look at Amazon, and so Amazon is creating delivery bots, and they're actually on the streets of LA.
Yeah.
Looking rather cute, I have to say. So this is the traditional warehouse versus robotized warehouse. So obviously a traditional warehouse, a worker is moving around the warehouse collecting items off the shelves. And in an Amazon warehouse, the shelves come to the worker, which obviously improves the productivity of the worker very substantially. And in the latest warehouse in Shreveport, Louisiana, it's using robots at every stage of fulfillment, cutting costs by 25% following 10% increase in robotics intensity. I wonder what the capital cost of that is, out of curiosity.
Yeah, absolutely. But we were talking previously about the coming revolution in robotics and how it is going to replace manual labor. Well, Amazon have very successfully done that.
Clever. So it acquired Kiva Systems in 2012, which I didn't know. And since then, it has produced 750,000 mobile drive units. And there we can see staff looking at how they work by lifting the pallets off their wheels.
Yeah.
They're like those mini vacuum cleaners you can get, aren't they, in similar sort of structure.
And so, I mean, that's it for this section. But I just wanted to show that the robotics when you look at these warehouses, they've completely restructured the entire warehouse so that essentially these shelving units move around and the worker stays put. And what's happening in logistics, you can see with improvements in robotics, you could have the whole of manufacturing restructured. We'll see, but it's coming.
Yeah.
And quickly onto Japanese debt sustainability. Now, Bank of Japan has raised interest rates to 0.5% over the last couple of months, and that's the highest it's been in many years. Wage growth has been rising to 2.8%. Inflation was 4% in December. But although it looks like Japan has escaped from its low inflation trap, actually, if you exclude all food and energy, and you're looking at the black dotted line here, inflation actually is below 2% and falling again. So bear that in mind. Inflation may not be as strong as it looks in Japan, but the return of inflation is having a very bad effect on the Japanese bond market. And reminder, Japan has a government debt to GDP ratio of 225%, the highest in the OECD. And 1-year yields have shot up from minus 0.2% 5 years ago to 0.6% now. The 5-year is at 1.1%. Again, it was negative not so long ago. The 10-year, 1.5%. And so you have had a 1.5% increase in the 10-year yield in 2 years. The 30-year is at 2.6%. It was at 0.5%. So you're having a 2% increase in the 30-year. And that is the 40-year, and that's at 2.9%. Again, You had a 2%, over a 2% rise. And this is wage negotiation. So every year there's a big, the unions negotiate the annual wage rises, and this year it's 5.4%. So wages are big components of inflation. That implies that inflation will stay elevated in the coming year. When you look at the trend in wage negotiations over the last few years, that trend is relentlessly upwards, suggesting that workers have lost the deflationary mindset and inflation may be becoming entrenched. So the question is, will the rise in Japanese bond yields cause a fiscal crisis of some kind? Is the Japanese fiscal deficit sustainable? Well, because the Bank of Japan bought a whole load of bonds, actually the net debt is much less than 225%. And almost 90% of Japanese government debt is held domestically, with the Bank of Japan holding 40%. So, as long as they can persuade Japanese banks and citizens to buy debt at any price, they don't have a problem. Now, as of September 2024, the Bank of Japan held 52.6% of outstanding JGBs and 46.7% of all outstanding government debt. These are shockingly big numbers, actually. Although the Bank of Japan's balance sheet appears to have stopped growing, as purchases are now more than offset by bonds maturing. The fiscal deficit is estimated to be around 4.2% in 2024. So the net debt burden is actually only 112.5% because the Bank of Japan owns 46.7% of total outstanding debt in issue. Therefore, a 1% rise in borrowing costs would raise the fiscal deficit by about 1.15%. So, current fiscal deficit is 4.2%. It would rise to 5 and a bit percent. So, those are uncomfortable numbers. And if the debt burden rises by 2%, the average interest rate on debt rises by 2%, then you're getting into really quite unpleasant numbers. But the US is running a 6.1% fiscal deficit this year. So bad, but not unprecedented, frankly. I think the bottom line is that Japan is not out of line with some of the other countries in the world, all of whom have fiscal deficits which are out of control and need to be reined in.
Yeah.
The irony is that the UK, the bond market has had conniptions about the increase in the UK deficit, but the UK actually does have plans to bring the fiscal deficit under control within a couple of years, unlike Japan and the US. And on to recession watch, Richard.
Thank you, Keith. So we got a beginning of a widening of credit spreads, which can be an indicator of stress in the financial system. Not risen to a huge, the spread hasn't risen hugely yet, but it's definitely on the up. This is an auto loan 60-day plus delinquency index, which is continuing to climb.
Yeah.
And actually a record level.
I thought this was amazing, actually. It's actually higher than, post GFC.
Yeah.
Amazing. So poor people in the US are struggling.
So this is a chart of manufacturing construction expenditure, which having sort of risen almost exponentially from 2022, has plateaued probably for the last 8 months or so.
Yeah. And that has been a big stimulus for the the US economy.
Yeah.
And it's now peaking.
Yeah. And the year-on-year change in manufacturing construction spending shows that it has boosted the US economy significantly. And quite a lot of this was the Inflation Reduction Act and the CHIPS Act, I think. Yeah. But now for the last 18 months is falling away as quickly as it rose.
Even before Trump's policy changes, the growth forecasts for the world were, and that is the light green line, were fading, particularly for the Eurozone, although obviously that may have changed now that the Germans have, announced big stimulus. And the only outlier was the US, which was forecast to grow decently, but those are coming off. So I think the bottom line is that growth forecasts for the world are likely to be revised downwards in the coming months.
Yep, undoubtedly so. Semiconductor sales growth is slowing, and obviously the question there is what will happen to capex. And it's interesting to see. Obviously, sales growth of semiconductors can't continue infinitely.
Yeah.
And lots of poor Americans are having to work 2 jobs to make ends meet. And that is, I mean, this is the UK, but when I was a child, let's say 55 years ago in the 1960s, it was the norm was that the mother stayed at home and the father went out to work, and that was affordable for middle class families.
Yes.
That is not affordable for middle class families now. And the same is happening in the US, but it's now moving on to 2 jobs, not 1 job.
Yeah. And I really think actually it's housing costs that are the big change. My father bought his first house for £5,800 back in the early 70s. It's just, the increase in house prices has been absolutely astonishing.
It is, isn't it? It's yeah. And this is the real-time Samral recession indicator.
Doing nothing.
Yeah. So recovery in the US seems to be remaining K-shaped, and the Trump administration definitely cutting government expenditure, which would, as Keith pointed out earlier, be expected to lead to a reduction in GDP and economic activity. You could argue that's a necessary evil to get the US back onto a sustainable path. The other question is Trump actually eroding the social contract, or are his actions necessary to reinstate what has been already eroded?
Yeah. Well, he doesn't care about the fiscal deficit. He wants to cut the size of government, but in order to cut the size of government, you've got to ultimately make hard choices.
Yeah.
So the big federal departments are Defense, Veterans Affairs, Medicaid. And, mucking around with the smaller ones like USA, that has no effect whatsoever. So unless he starts, in particular, Doge manages to take on the Department of Defense, he's not going to have any effect whatsoever.
Yeah, no, I agree, Keith. They have to pick the big ones, not the small ones.
Yeah.
And also, yeah.
And onto other charts. So global government borrowing that basically shot up during COVID and has not come down. So it's forecast to hit a record $12.3 trillion this year. Wow. Not good. Hence, gold is doing well. Now, markets are worried about stagflation, but that is rare. Low growth normally means low inflation. Now, Trump may manage to create stagflation by increasing inflation with tariffs, but that's normally a temporary state of affairs. Now, after all that, you need some good news. And actually, I have some really good news. I thought this was an interesting story. So, the Great Green Wall aims to halt desertification and return land to productive agricultural use in this huge 7,600 kilometer long corridor across Africa. So 11 countries. This is a huge project. Now, the Sahel, that is the area to the south of the Sahara, suffers from a drought flood cycle. So during the dry season, the ground gets baked hard and then when it rains, and it rains hard, the water can't soak into the baked earth and runs off, so you get floods. But there is an ancient solution to this, and it's the half moon pond. So what you do is you create these half moons, and the slope in this case would be left to right. Okay. So you're doing the moons
Yeah. So
face
you're
uphill.
creating little dams.
Precisely. Precisely, Richard. And
Clever.
that traps the water and allows it to then soak in slowly to the
Yeah.
ground.
Wow, look at that. It's
And
amazing.
yeah, 8 years later, and you can clearly see the
Mm.
little half moons.
Yeah.
Yeah. Okay, this is the most successful area. And this is southern Niger. And so I've highlighted this town to the left here. So this is 2017, 2024.
Goodness
So you
me.
can clearly see this is the same area. Okay.
That's
Before,
fantastic, isn't it?
after, has been a huge success in
Yeah.
southern Niger.
Yeah.
And this, I actually struggled to get photographs of before and after because frankly, it was quite difficult to be sure that the
Yeah.
after photo was, the
Same
before.
location. Yeah.
But this is from the World Food Program, so presumably trustworthy. But again, it's quite difficult to,
It's hard to line it up, isn't it?
yeah, it
Definitely.
is. The
Even the
land
trees
has
are
been
slightly different.
the land's been totally transformed,
Yeah.
basically. That it looks like a huge success, certainly in southern Niger.
Yeah.
And you're
Great.
halting diversification, and those you can actually grow crops, etc. there. So brilliant, and all done with manual labor. The peasants out with their hoes.
No need for machinery,
Mm.
expensive machinery.
And on to equities, Richard.
Thank you, Keith. So pretty much down week for equities, really. I'm just going to go through the major exceptions. So the Hang Seng was up 5%.
Yeah.
It was up 20% year to date. And the Topics was very slightly up, but almost unchanged year to date. And we have, in terms of currencies, both the euro and the US and the GBP were up against the dollar index, obviously down. And so the dollar index is actually still quite close now to the bottom of its more recent trading range.
Yeah.
And the VIX clearly is up substantially. I saw a chart of the VIX at the weekend, and it has been stair-stepping higher, not spiking higher, which suggests a gradual but consistent change of sentiment.
Right.
Which is quite interesting because often with what we've seen in the past is it's just spiked up and back down, but this is not a spike, this is a stair step. So I thought that was interesting. So there we have the World Equity Index down to 2.8% on the week, unchanged actually for the year pretty much. The FTSE All Share, which is up 4.5% nearly on the year.
Yeah, doing okay actually.
Yeah. The Euro stock's actually up 8% on the year. The S&P 500 is down 4% on the year. And the NASDAQ is down 8% on the year. Russell 2000, likewise down 8% on the year.
Yeah, so small companies in the US not doing well, actually. So when you look at the long-term chart.
Yeah, completely. The Hang Seng up 20% on the year.
Yeah.
A big outlier. And the Topics down 1.3% for the year, so very small change. Bitcoin down nearly 10% on the year. It has actually reversed a substantial chunk of the uplift that it had from Trump's election.
Yeah, but it's still up. I mean, it's still up.
It's still up a lot, yeah. And the pound, as we said, up at 1.29, which is almost quite close to its highest level.
Yeah.
And the euro spiked up very significantly, presumably, and up now 5% on the year.
Yeah, that's going to be after the Germany's debt rate coming off. Yeah, expectations of fewer interest rate cuts.
Yeah. The dollar index, as I said, down at 103, down 4% on the year. And there's the VIX.
Yeah.
Stair stepping.
Yeah, no, you're right. But I mean, that's not terribly elevated levels. But
It's not, is it, Keith? No. So to state the bleeding obvious, Trump's second term is not the same as Trump's first term. So we have on the left, we have Trump won on the S&P 500, and on the right it's the Russell 2000, and the effects are actually diametrically opposite.
Yeah. So what has really changed is he doesn't care as much about the equity markets. What he wants to do is transform the US economy, and if it means some short-term pain, then he's willing to take it, he says.
Yeah.
So an analogy actually is with the Nixon administration, which was, thank you to Jorit and Zendigan for sending me this. So Nixon came in with a populist mandate, and the Fed had actually cut interest rates before he was elected, and that meant it had to tighten monetary policy to avoid inflation. Now, this time, Trump is coming in and he is tightening fiscal policy to avoid inflation and a deficit bust. So, is this Republican president going to mirror Nixon and being very bad for the stock market? I think when we've gone through the Kalecki-Levy model, I think what he's doing is going to be bad for corporate profits, full stop, at a time when corporate earnings forecasts remain extremely elevated.
So what this shows is that Trump tariffs 2 against Trump tariffs 1. So obviously Trump tariffs 1 was pretty noisy.
Yes.
And Trump tariff 2 is actually quite noisy to date, isn't it?
Well, exactly. The question is, I mean, last time he just, kept on taking them on, taking them off, and actually, don't over extrapolate in one direction because he can reverse course.
Yeah. So analysts are remaining bullish despite the fall in the S&P and economic uncertainty. Well, we'll see, won't we? I mean, they're just used to upping their numbers every year. So.
Yeah, exactly.
And the market is remaining expensive. This is the S&P 500 price to sales ratio.
Yeah.
And it's very expensive in historic terms. And the underperformance of consumer discretionary stocks is shown here, which suggests that the market feels the consumer is actually in trouble.
Yeah.
And it's worse than the information technology, which is the second worst of these.
Yeah, now that I think is quite meaningful. That's basically saying cyclicals, they're not doing well.
Yeah. So this is a surge in the trading volumes on the NASDAQ, suggesting that, well, equities may have bottomed. I don't believe it myself. I think they've got a long way to go down. But I don't think they're necessarily going to go down in a hurry. I think it might be a gradual but fairly substantial decline.
Yeah.
But I think there will be a substantial decline over time. And suddenly risk appetite has fallen very, very rapidly.
Yeah.
And the euphoriometer is actually still quite high, isn't it? But dropping.
Yeah, that's because the forward P ratio remains high, as in VIX. Despite the spike in VIX is very low compared to. It's about average history of the last few years.
Exactly. Yeah. So this is the US equity performance every year for the past 15 years, with the 2010 to 24 average there at 12%. This has been the best since the 1970s in equity market performance, and I suspect we're going to see it going the other way now for a while. And this is the Magnificent Seven following a gunfight in which they were outnumbered and outshot.
Yes.
Obviously, if you bought them at the start of 2023, you would have done and very, very well. And you should probably be thinking about exiting them now if you haven't already.
Yeah.
This is not advice.
Yes.
This is fascinating. The dot-com darlings did experience very strong revenue growth from 2000 onward, but it was already in the price.
Yeah.
So
I find this chart absolutely amazing. The top one, revenues, sales absolutely did deliver.
Yeah.
But, it was all already in the price.
Yeah.
The P ratio just collapsed.
And the total return Yeah, over 20 years was 16%.
Yeah.
That's a real sort of wake up call, isn't it?
Yeah. Yeah. Thank you very much to Juliet for sending that. That's great.
So the average Russell 3000 stock is down 30% from its 52-week high.
Yeah. Yeah. The average, not the market cap weighted.
Yeah.
Average. Now, this all matters because we think that a big support for the US housing market and the US economy in general has been the equity market. And if the equity market now turns down and consumers start to feel that their wealth is falling, then they'll start spending less and you get a recession.
This is the average S&P return following 10% correction since 1980. And in theory, corrections are a good buying opportunity. My viewpoint is at the moment is they're not, unless you're really good at trading. I don't trade. I would never attempt catching a falling knife as far as I'm concerned.
Yeah.
And the US market remains highly valued. And Husband Strategic Advisors have been forecasting a crash for a long, long time.
They have. Now, I had a look at the Husband Advisors website and they haven't updated their charts for the recent correction, but it's going to be quite similar. As soon as they do so, I will report it.
And the US financial assets are also looking very expensive, actually.
Yeah.
Earnings estimates are well ahead of economic reality. And I think, we're going to see analysts starting to reduce their earnings estimates as opposed to increasing their earnings estimates year on year. I think we're changing in the environment that we're working in.
So prior to this, what this chart shows is, even prior to Trump, the estimates were way too high and they got to come right down now because he's going to be attempting, according to the Kalecki-Levy model, earnings will be falling, not rising. And so you've got big revisions in earnings if he follows through.
I think he will follow through. He's not going to suddenly turn around at this point. He's just firing his opening salvos. And as you say, he doesn't really mind he doesn't mind what happens to his personal popularity because he's not standing for election at the next presidential election. Well, I'm sure he'd like his successor to win.
Yeah.
So put volumes have spiked, people seeking protection from a falling market. And fear, greed index, extreme fear. But I would say we've got extreme fear at times of still extreme highs.
Yes, I totally agree.
Vanguard survey of asset allocators shows strong and consistent inflows into equities. But this chart is not sort of bang up to date, is it? It's up to December 2024. So will we start to see a reversal of this?
But you see, what's been driving the stock market higher is just relentless inflows into equities.
And particularly into ETFs.
Yeah.
Finally, I would say international stocks are beginning to outperform the US, reversing 15 years of underperformance.
Yeah. Okay, thank you, Richard. On to commodities and energy week. OPEC are going to follow through on increasing production from April, and I can't see any way that oil prices can rally given the OPEC's going to increase production by purported 2.2 million barrels over the year starting April. Industrial metals, though, were strong, particularly cobalt and tin. Precious metals were very strong. So starting with energy, Brent down 2.5%, WTI down 3.1%, Dutch natural gas futures down 5.6%, all good news. US natural gas futures, though, rising, up 10% over the past couple of weeks. Coal stabilized, but still down 20% on the year. Uranium continuing to fade, down 12.5% on the year. So this is Brent at its recent lows, not going anywhere. And frankly, if OPEC open the taps, that's not rising at all. WTI, just as bad, down 5.6% on the year. Numbers specific to the oil market. Well, despite the fact the oil market's falling, the inventories in the US have been falling. They're down 10 million barrels over the past couple of weeks. That implies the US market is undersupplied. US oil production rose back to the start of the year levels at 13.575 million barrels, and the Baker Hughes rig count rose one. It's pretty stable. So the IEA has increased its oil market surplus forecast for 2025 on the back of weakening demand. Not good for the oil price. These are EU natural gas futures, well down from their highs, thankfully. UK following. But US natural gas futures are rising again, despite the fact that the worst of winter has passed. Inventory levels are low, and we've got loads of new LNG liquefaction plants coming online, and their demand continues to rise. So are we seeing US natural gas prices starting to converge with European ones? Coal going nowhere. Uranium continuing to fade. On to industrial metals, Richard.
Thank you, Keith. So a bit of a mixed bag for industrial metals. We've got aluminium was up 3%. The last 2 weeks, cobalt up 57%, which is huge, isn't it?
Yeah.
Copper up 8%, 22% on the year. So copper's having a good run at the moment. Iron ore down 3.7%. Lithium carbonate pretty much unchanged. Neodymium pretty much unchanged, although up 13% on the year. Nickel up 6%. Tin up 14.7% and 23% for the year. And zinc up 5%, but pretty much unchanged on the year.
Yeah. Now, I would caveat with these numbers by saying that these are the prices in dollars on COMEX. And what we're seeing is American demand to try and get ahead of any purported tariffs.
Yeah.
So in the case of copper, Trump is talking about 10% tariffs on copper. So, you're seeing this Russian demand to get copper into the US.
Yeah. So there we have the chart of aluminium, cobalt.
Yeah, so having previously talked about how cobalt was dead as a dodo due to, all this like wall of supply coming out of the DRC. Yeah. In line with all my other prognostications, it's been totally wrong.
Copper having a good run. Iron ore, lithium, neodymium, nickel, tin.
Yeah, tin going through the roof.
And zinc. So precious metals. So good week for precious metals. Up, gold up 4.4% and for the week, or 2 weeks, and 14% year to date. Silver 8% and 17%. Platinum 7 and 13%. Rhodium 11 and 14%. And palladium 5 and 8%. I mean, the latter three, I suspect, being pulled up by gold. So that's a chart of gold for last year. Amazing,
really amazing.
And gold flows from Switzerland to the US. So a lot of gold is being moved. It's being taken out of the LBMA vaults in London. It's being shipped over to Switzerland to be refined from, what was it, into, I forget what it is, 1 kilo bars, I think, from 10 kilo bars, to be refined into a different size bar and then shipped to the US for vaulting in the US.
Wow. Well, yeah, this is partly responsible for the Atlanta Fed's GDP now going forward.
Yeah, but in my view, it's got nothing to do with tariffs.
Right.
It's all to do with what's going on with currencies and debt levels.
Yeah.
And gold discoveries have collapsed. So based on new supply coming onto the market, there's no prospect of gold supply increasing above the current annual supply level. And So the supply is constrained, the demand
Yes,
is increasing.
amazing. I thought this is an amazing chart. There's just like no new gold discoveries.
So there's silver, which hasn't really gone anywhere terribly much since May last year, but looks like it might be poised for a bit of a breakout. Time will tell. Platinum, rhodium, palladium.
Okay, thank you, Richard. On to rates, and another terrible couple of weeks for UK. 30-year back up to 5.3%. Basically, the European rates are risen sharply on the back of Germany increasing its fiscal spending. The fundamental problem is that governments around the world all increased their fiscal deficits during COVID and have got no plan to rein them back in. Now, the one exception, of course, is the UK. But the market is concerned that previously the UK has, said it's going to rein in the deficit, and then when it's come to shove, they haven't. So Rachel Reeves now has a problem. She's going to have to demonstrate to the markets that she is being fiscally responsible. We find out on the 26th. If she's not, bond yields spike and her problem gets worse. So if she wants to get the deficit under control, prudence now will save money later. The US, that looks a much more normal curve, frankly. But trueflation in the US is collapsing, and hopefully bond yields, that means inflation's coming down, the US economy is slowing. Will that allow the Fed to cut rates? The trouble with trueflation is it's not yet discounting the increase in prices due to the Trump tariffs. They will come through later in the year. And the Fed is going to find it difficult to cut rates given the uncertainties about future inflation. It's going to have to be cautious. This is the UK 2-year. You notice it's gone nowhere, but the 10-year's risen and the 30-year has risen. This is the US 10-year. Unlike the UK, the US 10-year has been falling. German 10-year gone through the roof. French 10-year. It's Italy. Italy's at 3.9%, and it's got debt to GDP ratio of 135%. So if it's, let's say, its average interest rate is 3% on that, it would need to be running a fiscal surplus, primary fiscal surplus of 3.5% to stop the debt growing. Greece. So concluding comments. Well, this is the Economic Policy Uncertainty Index, and it's going through the roof. So the data we've shown you this week shows little sign that the US economy is slowing as yet, but consumer confidence is falling, the stock market is falling. All that means that the economy is likely to slow further in the coming months. Richard, how are you doing?
So, well, obviously, doing okay, Keith, because my precious metals. So what I think what hasn't happened particularly is the mining shares haven't kept up with the pace of increase in the price of gold, particularly. And I suspect that's going to start to change now. And I've read a couple of commentaries suggesting that people are starting to move money out of the main stock market indices and into commodity mining. And if that happens as a consistent trend, clearly that's going to start to benefit commodity producers. So I also think actually that the price of gold is going to continue to rise for a while, just because of the huge amount of uncertainty in the world and the fact that central banks are still continuing to accumulate gold in order to insulate themselves from the US dollar system. Those are my general thoughts, Keith. What about you?
So obviously, it's a bit the bond trade is going absolutely disastrously. Just about everything that's gone wrong could possibly go wrong has gone wrong. But medium term, if the Bank of England gets inflation back towards 2%, and I think it will later in the year, then at current yields, the 30 years yielding 3.3% above 2.2%, 5.3%. That is just unbeatable, pretty much tax-free. So, um, getting positive real returns. And also, I mean, the problem with the UK is that historically, when you look at like the inflation break-evens, they all have inflation break-evens about 3.3%, i.e. RPI. Yeah. Now we know that starting in 2030, we move to CPIH, which is around 1% lower. So markets should then price bonds lower. So bond yields lower, which would be good for my trade, although many years in the future. But what I wanted to talk about this week was REITs. So as your regular viewers will know, I bought income and I bought REITs, and these are all trading at absolutely enormous discounts to NAV. So this is Care REIT, and it received a bid this week, and its share price has shot up to 109. It's actually the bid's at 108. But even after that, it's got a discount to NAV of 42%, apparently.
It's extraordinary.
It's absolutely extraordinary. And so what is happening is that, so this is another care home provider is bidding for it. These are being taken out so either the management is doing something or they're attracting bids. So this is another one I've actually got a big position in. This is Labs, which invests in, it's been developing life labs basically, and then trying to rent them out to life science companies. And historically, it's been a disaster. Essentially, the building was delayed, and then they struggled to get occupancy. So what they did this week was they cut the dividend to zero, but they said they were exploring all options for their business, i.e., they're either going to a sale or a wind up. And the share price leapt. So it is on, even after the leap, it is on a 42% discount to NAV, i.e., if NAV is anywhere near the true value of the assets, then you've got a 70% return. This is Warehouse REIT. Again, it's got a bid, share price leapt. That was a few weeks ago now. This is earlier in the year and one I sold. BBGI Global Infrastructure, again, taken out. Now, what you see in many of these cases, like Warehouse REIT and BBGI, is this dip in the share price is because the bid price included the dividend. And if they then subsequently pay a dividend, the bid price falls. So today I'm going to be selling Care REIT, which has attracted the bid, and I'm going to be putting it back into other assets. So this is Social Housing REIT. It is a discount of 54% of NAV. Now, it's got a couple of underperforming care homes, but new management. And again, you can see a bidder coming in and cleaning up the business. 9.4% divvy. This is the healthcare REIT portfolio of care homes, only a 20% discount to NAV, but it's not necessarily the ones with the highest discounts that are being taken out. It's the ones with the best quality assets. This GCP infrastructure, long-term infrastructure projects, 28% discount to NAV, 9.3% dividend. And I also yesterday spent some time looking at the battery storage ETFs, which have been a total disaster. So, reminder, the reason that they are in trouble is that the UK grid is choosing not to use them. The UK grid, these battery energy storage companies have electricity capacity available for when the wind doesn't blow and their electricity is needed. But because the algorithm that the national grid uses, it's choosing not to use batteries. It's choosing instead to turn on the gas. So they've been lobbying, and by 2027, that problem should be fixed. In the meantime, they have Gore Street, so Grid, which is UK focused, GSF is more globally focused. Grid has done a tolling agreement with Octopus Energy, and tolling means Octopus Energy actually take over operational control of these batteries. And that's provided revenues. Revenue growth is much stronger in the second half. And frankly, I thought it looked interesting. You had a 58.5% discount to NAV, dividend yield 12%. So it wouldn't take that much good news to send the share price flying. And in the case of Grid, it currently doesn't pay a dividend, but because revenues have improved, it is hoping to reinstate the dividend this year between 4.5 and 6p. So that would mean yielding about 10%. They intend to do that after they've refinanced the debt. So all of that looks quite interesting.
Good. Interesting, Keith.
Okay, so that's it. Thank you all for watching and sticking with the podcast. So the next one will be in 2 weeks' time, but some stage during the week, as I will be walking for a week beforehand, so I won't have a chance to do any work. But I'll do the work, and then we'll do a podcast in 2 weeks' time. By that stage, we'll know what has happened to the UK budget deficit. So, interesting times. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.